appreciate the opportunity for you to come out here Monday morning. I know it's early. Uh, my name is Ed Wenzel. I'm with Certified Mortgage Planners in Lake Mary, and I've been in the residential finance construction business for 25 years, the last 15 years here in Central Florida with my family. I was telling Diogo I have 4 sons, 3 are born here in Florida, so I'm officially outnumbered in my household with Floridians. I partner with Stacy Luna. You'll see that name, and I'll have some cards for you as well. In the event that I'm not around, Stacy's my backup and vice versa on her accounts, but she has also met Desiree and Diogo in the past. Before I get into the presentation, I'd like to give a brief overview for some of you on the mortgage arena here in the United States and why foreign national loans take a lot of work for us to find them and to be able to do them in Florida. Here in the States, if you're familiar, the residential market consists mostly made up of what they refer to as conventional loans. And those are loans under $417,000 that are underwritten to Fannie Mae, Freddie Mac, FHA, USDA, government agencies. And they all have their own standard rules and regulations and conditions and covenants of what they want the loans to look like. So if a borrower comes in and they can apply for a Fannie Mae loan, we take that loan, we take that information, and we put it into their approval system. They each have their own approval system. Hit the magic button. 5 seconds later, it incorporates thousands of pieces of data and comes back whether it's approved or not. And if it's not approved, what we need to do to clean it up. The reason they do this is they take those loans and then they bundle them. And then they bundle them in large packages called mortgage-backed securities, and then they sell them on Wall Street to investment firms. So firms may pay $250 million for 250 loans, and they're buying the servicing fees and the ongoing interest income on that. Now, the reason the investors do that is because they know the quality of the files are underwritten to the government's particular standards. When you go above 417,000, you're going into the jumbo loan market. And jumbo loans typically are not sold on the secondary market. So what they refer to those as portfolio products, because the people that will make those loans, the investors, hold that paper themselves. So if I were to start my own business and I had a jumbo loan product, I could make up when any regulations I wanted and just did the jumbo loans because it's my risk that I'm holding it. Foreign national loans fall into that same program. Foreign national loans aren't sold or bought on the secondary market. The investors that I'll show you here today have a product specifically for foreign nationals. So what you end up having is a very wide variety of conditions and covenants from one lender to the other. So some are going to be comfortable with 65% LTV. Most are comfortable with 50% down and 50% loan amount. Others are going to require translated documents to be certified. Others are going to go with the stated income. It's whatever their comfort level is, and that's why they're priced a little higher, and you run into hard fees on some of those loans. So it's just, I want to give you an idea of why foreign national loans are a little harder and a little more difficult. And after I met Diogo and Desiree a few weeks ago, I went out and researched to try to find more options on viable lenders in the states that will do foreign national loans. Unfortunately, Florida still has kind of an aura about our real estate environment here. And there are a number of very good firms, particularly in California and Texas, that have very good foreign national loan programs. And they're easing their way east. And I've spoken to them, and Florida's on the radar. So I can comfortably say that probably in 90 days, I'm going to be able to present a better product array than I have today. But what I want to show you today is exactly a couple different options that we have and what the little differences and nuances are. So make it interactive, ask any questions. I'm not going to know all the answers. I share with Desiree, this is what it's 76 pages. It's just one company's guidelines for their portfolio products, which would include foreign national loans. So there's a lot of data. But what I want to give you is just a broad overview of what each of those can offer us and where your particular client might fit in that niche. And our first option is with NP. Now what they're going to require here in Florida is the borrowers, that's going to be the same for everybody. Proof of legal status to be in the USA Visa Passport B1, B2. They will go to a maximum loan amount of 65%. They'll have a minimum loan amount of 100,000, a maximum loan amount of 650. Now, if your borrower does have a Social Security or a TIN, and you can pull an account credit report, and they have a 680, you can go to 650. If we're dealing with an international credit report that doesn't have a score on it, it's going to be capped below. Well, it's not going to be capped. It's going to be capped at 50%. So whatever your loan amount is, it's going to be 50% of that value. But if you do run into that case where you have a 680 FICO, this is the only one you'll see today that gives you that option. You could bump it up to 650, but it's still going to be a significant down. Rate options are standard arms and fixed rates. We can talk about that a little bit later. This is something that is of key importance. And in the past, I don't think you ran into that ratio. And let me explain what that is, because all these companies are going to look at this very, very closely. That is your maximum DTI is at the end of the day, they're going to take your client's total gross monthly income and divide it by the total expenses that you're going to have. And they cannot exceed 43% on the back end. So what they're going to do is they're going to look real closely at the income coming in and what the monthly expenses going out are. And they're going to have to translate that off the bank statements as best they can. So you're going to run into more of a DTI because, again, these are investor loans and these are the guidelines they set. This particular company, you don't have to worry about the credit report. They will run a credit report using all nines with their address in their home country of origin. And they'll come up and see if they can pull out a credit score. If they do run that and you do get a credit score, you could get a higher LTV. Location type, true second home. No resort properties here. Condos are considered with a standard questionnaire, and we've already had those questionnaires in. So if you get a particular new development that you're looking at that you're not sure that they're going to be able to lend in, it's called a PUD or a condo questionnaire. If it's a condo situation, you're 100% of the time you're going to need a condo questionnaire that's going to look for detailed information on how many units are sold, how many units are rented, that type of information. But don't let that scare you away because you have other options. Any questions on this so far? It's just a broad overview of what we're looking at, okay? All right. There you go. Here's one little nuance for NP. They'll only finance one property in the United States for your client. Only one. If your client already has a second home financed in the United States, they will look at it on a case-by-case basis if it's located a decent distance away. So if they have a second home in Serenity and they're going to come to NP and look for a loan for a second home from NP, they're not going to do it because it's the same community, it's the same neighborhood, it's the same city. So that's one idea. And these are little things you can probably, as we fine-tune with Desiree, little questions that you can ask your clients up front. And over time, as you ask a couple key questions, it's going to filter into which matrix works best. And I know it's a lot of information, but it does come pretty easily to you after you do it a couple times. This particular company will only close in a personal name, no LLCs. And that's just their prerogative. The reserves, they require 24-month reserves with 12 months being in a U.S. bank account with auto debit. For some countries that are on a watch list, all 24 months need to be in a U.S. account prior to closing. So Brazil's not the closest country that you'd be dealing with is Venezuela is on the watch list now for most of these investors. Mexico is. It can be. I don't know. I don't know. I can look. I have a list, but on that list they all change too. But I don't think Mexico's come up. Oh, the question was where we are in Mexico. If Mexico is on that list, and I'll research that and find it out. But I'm pretty sure it's not. I haven't seen that. Another thing that's of interest to you all is a power of attorney. They do not allow power of attorneys. If they do a mail away to Brazil, it has to be in the U.S. consulate, the closings. And that's pretty standard for all the investors that you'll see today. So you can mail it away, but it's going to have to close in the U.S. consulate. Documentation. Now, in this particular situation, all the documents have to be translated by a certified third party. This is where it can get a little tricky and where your costs can start increasing. Standard 2 years tax returns, 2 months recent bank statements, recent 30-day pay stubs showing year-to-date income, and other documentation that may apply. So in this particular situation, notice they're giving you a higher LTV than the other ones you're going to see today, but they're requiring a lot more documentation up front. The couple key things, and I'll hit on each of those, is on that documentation, or I'm going to hit on that documentation and that LTV on each of the ones we present, so you see the differences in how they price them out differently, so you know what your best options are. So that is that first option that we now have is New Penn. Option B is AV. Now they'll go as high as 50%. They can go to 65% if you have high compensating factors. What's different about this company than option A is they're very asset driven. So if your client has a lot of assets, a lot of investments, good rental income, that's what they want to see. A lot of times folks are very cautious, and I can understand, to show as minimal amount of assets as they have. We'll tell them you need $55,000 to close. That has to be deposited in a U.S. bank. It may or may not need to be sourced. That's all they're going to show is $55,000. If you have a very wealthy liquid investment, this is a very good option for you. It can go to 65 on a case-by-case basis. This particular investor goes by a loan committee. So as you recall, when I started off, when I said about the conventional loans in the United States, we have an engine that we run it through for approval. That doesn't happen with these. These are people sitting around a table. The information that you give me through Desiree, I give to my account representative. We go over it, and he presents it to the committee around the table, and then they decide where they're going to go with it at the end of the day. So the more information we give them, particularly up front as we establish these relationships, the smoother it can go in the long run, and the better the performing loans in the long run, they'll be more apt to be a little more aggressive with us. The very good ARM rates here, very good ARM rates. That's not interest only, that's P&I. But on your DTI here again, the back end ratio is 40%, and that's capped, okay? The credit report, basically the same. If it's not a TIN or a Social Security, they'll run their own international credit report. Now, what's very interesting about this company, more than any other, is it has to be in a resort. And that's very different, because a lot of these investors do not want anything to do with resort communities, because you run into rental agreements, short-term rentals, long-term rentals, but they have no problem with it being in resorts. And this is one of the few investors that you run into condotels. Condotels are very popular in Orlando. They're coming back again. Good rental income sources. And non-warrantable condos they will accept as well. So these are the basic amounts for what they're going to do is a little bit different. Recall in the first one it was 43 here. It was a higher LTV. Their location wasn't too conducive to a resort. They prefer a regular community, and they roll off of condotels. Same credit report criteria. And here's something very important, because I've seen a number of your applications right now. The number of properties are unlimited. So if you have a client that has 20 properties, and some of you do have those clients, they can apply to that. Option A is limited to 2 finance properties worldwide. This one is not. Notice that they're going to require a reserve of principal, interest, taxes, and insurance. So that means 12 months of those payments for each of those rentals properties that they own. If it's financed, has to be reserved in an escrow account. Now what they will do is they will take rental income from those on a case-by-case basis. So here again, when you're dealing with an investor that has a portfolio product, basic guidelines, but you see a lot of this case by case basis. So what you do, you almost become a detective in your job, and you find out and you ask the right questions about, if the property's financed, that's not a problem. You can show reserves on it. Can you prove income? The challenge a lot of times you run into that is your clients get paid in cash on their income. We can't source that. They have to have a check. It has to be a check to a rental agency or even a check to them and their company. But it will be considered. So it's kind of an offset on that. So here again, there's give and take here. They don't care how many properties they have. If they're financed, they want them reserved. Or they'll consider using the rental income form. Again, very asset-based option right here. The more assets, the better. They will only close an individual name, no LLCs. Okay. Reserves, 12 months PITI for the property finance, which piggybacks to the number 2. They will accept the power of attorney, and it would have to close in the U.S. Embassy if it's done as a mail away. Standard for almost all of them. The mail away is standard for all of them. The POA is different. Question.
Once you close, can it be, if it goes under an individual name, can it be transferred to an LLC?
The question is, if the loan is closed under an individual name, can it be transferred to an LLC? The short answer to that is yes. The compliance answer is no, because the loan was underwritten in good faith that the mortgagee was going to be in that particular entity. They would at one point in time have to sign off on that, and if they come back and see that you did that, technically they would come back and say, that's a violation. So that's something we want to do. In the States on a Fannie and Freddie loan, depending on how it's underwritten, you can do that. But you typically don't want, if in good faith they're asking you, it has to be an individual, they don't want you leaving the closing, going to the next room and flipping it over to an LLC, because it's eventually going to get recorded. So it's something that I would in this environment take the high road and say not to do it. The question was, can you get an exception from them? And the answer is yes on that, because here again, this is a portfolio product and they're going to go in front of a committee on that. If we show extenuating circumstances on why we want to do that, that may be something they look at. They may have, for one reason or another, Diogo, a possibility in the past where it was too hard for them to go after an LLC here. And you'll see on option D, they allow LLCs as shell corps in Florida. The exact opposite of risk mitigation that you got here. The exact opposite. So watch on each of these. You'll see different levels of give and take and how they price them out. Any other questions? I think that's the last slide I have on. Oh no, I have one more here. Let's not forget about income documentation. What we call a W-2, a wage earner. Most recent years W-2 equivalent, not the tax returns. So if you have a W-2 equivalent, that's going to work. Current pay stub showing year-to-date income. An employer letterhead stating position and earnings. Now what we have to comply here is that employer letterhead stating position and earnings is going to have to be on the company letterhead. And it's going to have to be signed by an officer of the bank, and it's going to have to be translated. And what we're working on is, can we translate that here and attach the original to it like we can on option D, or we'll just have to get that one page translated, which I believe one page is $29. But these are the costs we have to watch out about. Now you go to self-employed, 2-year personal and business tax returns, current year-to-date P&L, CPA summary translation to English and US dollars. Keep in mind, again, as I go through these, you got a self-employed borrower, this is going to be a lot of work. This is going to be a lot of work. So consider pricing and fees when we look through some of these options. When you have a self-employed borrower, they're going to be looked a lot different than a wage earner. Okay? So that's why you're going to see a variation in prices and fees. So don't shudder when you see some of the pricing and fees, because it's how much you want to make this a great opportunity experience. Thank you. A great experience for your client because you want your client to refer back. And the best thing I can tell you to do is position yourself each time you talk to that client that there are a number of opportunities available for foreign financing in the United States. There are many different intangibles on all of them. I'm going to find the right option for you. It may not be the most inexpensive option, but in the long run, from an experience standpoint, from what you're going to have to document and show, this is probably the best route for you to go. So it's going back to that idea of being a trusted advisor for your client and telling their client, this is what's best for you. These are the different options. This one may cost a little bit more, but look at what you're going to have to provide. And you're going to have to get the tax return translated. And that has to be done by a third party. And that's going to be a big nut right there. If they're self-employed. Their wage earners is a very good opportunity. The VOE, and this is they have to join their credit union. There's a no-cost membership to do that, and the loan is not debited from that account. So I'm not sure. I think it's just signing a piece of paper that you would join the credit union and you get a fictitious account and they get a check mark for a cross sale on it. Verification, VOE is a verification of employment, translated English on employer letterhead. So just a verification of employment has to come from the company, stating typically on the foreign nationals when we say VOE, we're looking at somebody from HR on the company letterhead. So-and-so's position here is X. They've been here for X years, and they typically make X amount of dollars a year. Short and sweet, something very easy like that. That's all it is. It's the same you can do in the United States. You usually do that verbally. You can do that verbally. That might be. Any other questions on option B here with AV? Am I going too fast? Am I covering too much? Go too slow? Now we're going to go a different animal here altogether. This is going to be a hard money option on option C. Maximum LTV is 60%. They require 40% down. They have a minimum loan amount. The LTV is the loan amount, loan to value. Everybody understands. So it's the loan divided by the value, and that's how they determine the appraisal and how much money down. Okay. So if it's a $100,000 property, the maximum loan amount is $60,000, and $40,000 in equity is going to have to be put down on it. This company is the only one that's going to go under 100, which is important because all the other ones you're going to see are capped at a minimum dollar amount of $100,000, and you'll see why in a second. Their rate options, it's a 10% rate for 2 years, interest only. You won't get this in writing, but typically if it's a paid on time, they would agree to continue it year to year. In their experience, usually after 2 years, they find that the individual either sell it or flip it or finance it permanently at that point. They don't require a maximum DTI because this is a no doc minimum requirement option. So there's no income that you collect on this. There's no income documentation. There's no asset documentation. The DTI is debt to income, so there's none. So in this particular scenario, they don't want to see anything income. Okay, this is a hard money solution for them. The income doesn't matter to them. To them, it's an investment that you're putting 40% down on that they're making 10% interest only, which 10% might sound like a lot, but when you're talking about interest only, it's only a couple more bucks on a monthly amortization schedule. Points are going to be 5.5. Okay, here again, they're pricing the risk here for themselves and the investor. It's a 10% rate at 5.5. No credit report. Basically, location type, anything. 5% 5.5 in a $100,000 loan would be $5,500. It's a point, right? It's an upfront point. So the fees, the points, fees, 1 point is 1% of the loan amount. So 5.5 is 5.5% of the loan amount. So if your loan amount is $100,000, it's $5,500. Now weigh that cost to what you're picking up here in terms of dealing with your borrower. No credit report, no income documentation. They don't care how many properties you own. Their closing entity, they won't close in a personal name. They'll only close in a business name because it's a business loan for them. Okay? So it's a different type of animal. All they require from a reserve is you have a U.S. bank account. Now, understand, with the Patriot Act, every foreign national loan, the monthly payment has to come from a U.S. bank. It can't be wired in from international bank anymore. So the money has to be there. They do not care how or why and where that money comes from in this particular case. All they're saying is somewhere between the 1st and the 10th of the month, we're going to debit your account for $1,000 interest. It better be in there. We're going to get a late fee, and they don't care when you put it in. For some of your other clients, you're going to see they're going to want to see the money sourced and to stay in the United States for 30 days prior to close. Here again, they're giving you a lot more options here. It's a lot less headache for you and your clients. You're paying points. You do get 40%. You do get a decent LTV. It's better than 50. But these are things, mail away, yes, closing U.S. Embassy. All they want to see is a B1 or a B2. They can close a loan in 2 weeks. They order the appraisal. You show them the visa. What did I share with you, Desiree? You show them the visa, the contract. They'll order the appraisal. It's $350. Your closing costs are very good. And they can turn it around and flip it in 2 weeks. Any type of precious property, any type of property. The maximum loan amount for these, probably, I can look for you, but $1 million. Yeah. Question? Okay, that's no problem. What you run across here, typically on a domestic loan in the United States, the client does not play points, and points is the investor or the bank makes money 2 ways: the interest income on the loan and the hard fees they collect up front to offset their processing, their underwriting, or in terms of points, these are just hard fees that they get. In this case right here, they're asking for 5.5% to mitigate their risk. Okay, their risk here, if you think about it, they know nothing about your borrower. They're not even looking at your borrower's income. They just want to make sure they can fog the mirror. And in lieu of that, here's where the balance is on each of these that I show you. Is there's takeaways and there are giveaways. Yes, it's 10% fixed, again, interest only, and they're going to charge 5.5 hard. So that's going to be $100,000. Is going to show up as $5,500 fee. That's coming from your borrower. That's cash to close. That's going to be included on time only. So at closing, boom, that's all going to be on that, and it'll all be explained prior to closing on the statement. So the other ones you don't see as many points, but they're leveraging what they want to get out of this by basically requiring nothing. So if you have, it's really going back to your borrower may go, whoa, 5.5. I'm paying, if it's $100,000, I'm paying $5,500, and my interest rate's 10%. That's really high. It's your opportunity to turn around and say, look at the offsetting factors here. If I were to go and get you a lower interest rate with no fees, it may not be 40% down. If it's option A, it's 35. If it's option B, it's 50. So here you're only putting 40% down because 100 minus 60 is 40. But you're not getting documents translated. They're not getting their information probed. You would be pleasantly surprised. Some of your clients, when they hear this, would go, yes, I don't have to show you any documentation. Right, you don't have to show them where the money came from. They're just a hard money lender. Where's the cut button there on that one? Yeah. You might not want to show up with cash. I would write a check. Yeah, no, yeah, I don't come up with a suitcase. I would keep it. Question.
If he decides to pay off before the are they gonna track where the money came from? Is there any prepayment fee?
They're not going to track where the money came from. The prepayment penalty fee is a good question on that. It is the prepayment penalty. I didn't include this. It's in the first year only. Um,
Before you answer,
yes, it wasn't.
in 9 months, they can close. They can pay it off after 9 months, but then they have to pay the 3 months left in fees. So 12 months total.
Okay, so if you pay the loan off in 9 months,
You just pay the
it,
fee for the 3 months left.
the interest payments for the last 3 months.
Right here.
So that's just a different. It's a different animal, different position. But you'll have borrowers that might want to gravitate towards this. You have borrowers that might feel more comfortable with another option. Okay. Option D, yeah, SN. This is right up in Lake Mary. Um, I just got the go ahead to work with these folks. This particular product is sort of a hybrid of what you've seen so far. They'll go a maximum loan amount of 65%, meaning 35% down. So $100,000 down money is going to be $35,000. The minimum loan amount's 100. Their rate options, it's fixed at 8.99 for 5 years on a 30% AM. So it's amortized over 30 years. All loans are. And then after 5 years, it's a balloon payoff. Here again, it's going to be 5.5 points for them as well. They have a maximum DTI of 40%. They're going to pull no minimum credit, so it doesn't matter what the credit report states if they have one. But they'll pull a tri-merge like option B would. They use all zeros. No, they don't want to see any assets. Okay, so here's where their give back to you is. They're not going to see any asset requirements whatsoever. So money to close or anything like that, it's not going to be in there. Location type, condos on exception, no manufactured homes, but typically everything else that you deal with ends up being right there in terms of properties. So here, it's a higher LTV, meaning a lower down payment. You're going to be fixed 9% for 5 years with the balloon in the 6 years. You have a 40% DTI cap, which probably why they make that rate lower, because they control the back end. They're calculating this off the information you give them. They'll pull the tri-merge, no asset requirements. Okay, a 5-year balloon is when you amortize a loan over 30 years. Okay, so you'll do an amortization schedule at 8.99% over 30 years. So you'll get a monthly payment of, say, $1,550. So you pay $1,550 for 5 consecutive years. Each payment you make, a little bit more goes towards the principal reduction of that. When month 61 comes, they want the loan paid off. So that's what a balloon payment is. So either you go back and refinance the loan with them. So in the 5th year or the 4th year comes around, rates may come back, and you can go, your loan's going to balloon next year. You're going to have a big payment. Let's look at refinancing it now and getting another 5 years from the investor. If they're going to sell the house, then they'll balloon it. But typically a balloon payment, when they require that, it's just an opportunity to come back and you can refi it, or they might sell it and be away with it anyway. But that's just good to know, and it's a good question. But that's what typically happens after 5 years. So you do see balloon payments. Here again, unlimited properties. They really don't care where you have the properties. Here again, you have to close in the U.S. LLC shell company. Okay, it's not a personal loan, so they're closing it. Um, this this reserve requirement, and I'll read this for you. The account must have the standard HUD required funds for taxes and insurance escrow funds to close. So when we calculate for closing, we escrow for insurance and taxes on that loan. And typically you have to pay those at closing. They want those in a U.S. bank account prior to closing. Okay? Not sourced, but they want them in there for closing. Why they do that? They don't want the suitcase coming to closing, as a bad example, or they don't want a check coming in on a wire the day of that they can't figure out. They want to see the money in there. Not 30 days. They just want to see it in the account prior to closing. What's going to be required. And that number is going to be an estimate, because you get to the closing table, or you get 2 days from closing. You know what happens if roof leaks or something goes wrong or someone got called out of town, and you got to delay the closing 2 days or move the closing up 2 days. It fluctuates. So it's going to be a roundabout number. They do allow power of attorneys, and the mailaways can close in the U.S. Embassy with the consulate there. Now, in their asset requirements, their assets are not sourced, okay? So what that means is, if they give you a bank account and Desiree can translate that bank account, if there's a deposit that's not typically looks like everybody else, like for instance, $120,000 got deposited in this account, and over the last 60 days there was never $120,000. In the States, we require that to be sourced. We want to know where that came from for a couple different reasons. If it's there legally, or two, if it's gift money, if it has to be paid back. So you typically never want to see a large dollar amount get put into a checking account 30 to 60 days prior to closing, whether it's domestic or a foreign national loan. So they're not going to source it. They can translate it. Same with investments. If it comes from a Brazilian CPA or a bank officer, Desiree can translate that and attach it to the original documentation and submit those together. So here we're not going, as of now, we're not going through a certified translation for this, but they're just asking for whatever's going to be there, that we can find it and have it transferred into the U.S. bank for closing. Here again, no tax returns, no certified translations. You're paying the 5.5 points. You're paying 899, not 10, and you're getting 65%. So your borrower is only at 35% down money. So each of these four options, I think I have one more page on this. There we go. This is a verbal verification of employment. They don't require any income stated. They don't want to see income statements at all whatsoever. If it's a self-employed borrower, letter from the CPA, company name, license, years in business, can be in Brazilian. Here again, translated by Desiree. W-2, same as the others. Name of company, position, years at work, translated, boom, attached. Minimum documentation. Nothing certified. We're not going through leaps and bounds of tax returns. Unlike option C, which was hard, here you are getting a little bit more documentation on a bank account statement to verify you have money that you can close the loan. No prepayment for this particular lender. Okay.
The difference between C and D is the balloon, and the interest rate. Is that?
Difference between C and D would be, okay, one, they're going to require 40% down. They're, they're going to be 10% interest only for 2 years, where in D, you're going to have a 5-year P&I payment, not just interest, and then ballooned. But this would expire technically after 2 years. You'd have to get it. Both are going to require the same points. Both aren't going to require the credit reports. Both are very flexible on location types. Same here. Same entity. It has to be an LLC. Reserves, basically just showing money that's available to close that can be sent to a U.S. bank account prior to closing, not sourced. Both can close in an embassy. This is more of a true doc. Again, you're showing the visa, the B1, the B2, a copy of the executed contract. They're going to do the appraisal. It, the closing costs are very minimal for this one. Um, it's almost, I hate to use the term sign and drive, but it's pretty close. Yeah, see, right. This is a group out of Miami. Okay. Well, they have a lot of foreign investors, and real estate in the United States is highly coveted, particularly in Florida. It is sort of the world's playground, as you know. So they have it's safer internationally to lend here to do that. That's why you'll see some of the foreign-owned entities offer these products, where the homegrown entities offer portfolio are a little bit more stringent on it because they have to hold it, and they're also um, well, it's not so much not where the money's coming from, but the entities here are bank regulated, so they will get audited. The hardest in the world don't. That's just typically, basically a business loan. Question. Right. So you're paying if it's $100,000 loan at 10%, it's $1,000 interest for each month for 2 years, and then you go back and renegotiate it, or they pay the loan off, or they sell a property. Some clients don't want a long-term loan, so after 2 years, they may in fact move here, and then we can underwrite them hopefully as a standard U.S. loan and make it a standard full doc and get a much lower rate and a 30-year fixed. Okay. Rate wise, if I knew what was going on rate wise, I love being here, but I wouldn't be here. I, I'd be on an island somewhere. It's just you don't know who to believe. You don't know. 2 years ago, they said rates were going to be 10 by this summer. Rates are still very good. You had a 5-year arm up there with on option B, which was 50% down, so it's a 50% LTV. Uh, but the flip side of that is right. The protection you have on the back side of that, it's only at 50%. So that's how they all manage it. They all do it a little bit differently because they all have different ideas on what they want to do, what they want to invest, and I can tell you that these can change overnight. Yeah, some could come in and this company might just say, you know what, we're not going to do Central Florida much anymore. Interestingly enough, a lot of companies in Miami are flourishing on the hard money side because you can't get a loan domestically in Miami or Dade County, and that's those guidelines are being loosened up. So they typically have limited themselves to South Florida. So I've spoken to this individual, and he is open to Central Florida. Um, so that was one opportunity I had to introduce him to the Central Florida market. And there's one other Miami bank that Desiree found, and I do have their guidelines. It's a viable option. It's another kind of a hybrid between the three of these, which is interesting to look at. But there were some key questions that I had for them that I didn't get answered, so I didn't want to put that in the presentation before I nail it out. For instance, I have to review the broker package that they send because it's our license that's on the line if we're doing business with them. So sometimes it just takes time. Other of these, it can happen real fast, but I'll work on that fifth option. It's not that I want to inundate you with options, but if you notice, not all these are the same. So you might get here early on in the conversation with your client, how much documentation? I hear you have to provide this. You have to get this. Well, no, there's another option. You might pay a little bit higher in rate. It might be an interest only. You might pay 5 points hard, which is $1,000 for every 100,000. But it's minimum documentation. You have to provide 4 or 5 items, and that's it. We can close in 2 weeks as soon as the appraisal comes in. And now all of these, just like a standard conforming loan, the loan amount is going to be the lesser of the purchase price or the appraisal. But that's standard real. That's about the one standard real estate piece across the board for portfolio or non-portfolio. So it's always going to be the lesser of the appraised or the contract price. Question?
And the 5.5% is not negotiable.
Now, no, that's the breakaway points between us and them, and that's their giveaway of reducing this amount of work. So it's a little bit more money. It's always better to have $1 in the hand today than tomorrow. So they want some of that investment up front right away. Question?
How much higher is that option when they compare with option B? I'm talking about the main option. Because I cannot how can I explain to my client what's going to be?
Between here and B?
Yeah, for example, because it's a totally different
Right, right. Well, here, don't forget the what? The question is, what's the difference between option B and C in terms of rate of interest rates? Sorry about that. The difference is option B is going to give you a better interest rate, but you're almost at a full doc loan. So you're going to have to do, and this isn't that bad, PTI reserves on the properties.
I'm talking about numbers.
Right.
You have a lot of work to do afterwards, but I'm talking about how much higher it's going to be.
Right.
10% because it's interest only, right? It's different.
Well, the 10% is, oh, I did it again. The 10% is on D.
Yeah, but I have to give you a sense how much higher so I can tell. You don't tell. I don't tell. You don't tell. That's not your job. That's what I'm saying. I'm gonna get you in contact with the person that's gonna explain to you.
So, and for instance, you have a higher interest rate here on B, but you're only paying interest. Okay. So on C, you have a good 5-year ARM rate that's 4.5 better than that, but you're paying principal and interest and taxes, insurance on top of that. And on B, you're getting a better interest rate and less fees because it's nearly a full doc loan. Remember too, it's 50%, and then if it's self-employed, it's 2 years business, 2 years tax, and a year-to-date P&L. It's a lot of information, and you have, as you have questions, we can review it. Um,
But that's just one thing. The beauty of, like I told you guys in the beginning, the beauty of this is just so you have it over a fee. You're not, you should understand it and sit down with Desiree and Ed again, just go through it again to understand it. But you're not talking to this about clients. That you don't have a license to do this. You all understand that, right? So you don't, there's when we're talking about having a higher interest rate, there's a reason it's a higher interest rate. It's because there's very little documentation. If it's a lower interest rate, there's a lot of documentation, but that's not your job to educate the client on what's best for them. Let them ask the questions, and then they'll say, listen, these are the best options for you. Does that make sense?
or you might have a client that comes to you and say, I'm self-employed and I'm not showing income. And in the back of your mind, you know that it's probably C or D at this point because they're not going to require that documentation. So if you pick up key words in the initial interview process about what they do, you in the back of your mind, you can kind of, when you talk to Desiree, going, there's no income there.
The answer is always, I got this perfect for you.
Yeah.
That's it.
Well, we really do.
I mean, look at this. How many options?
Yeah, we do have it. We do just about have an option for everything.
Remember what I talked to you guys in the beginning when we had the problem with the BBVA? We're only depending on one bank. And everything that, sometimes we get stones, thrown at us because we get good options. Look how many options we got now. We only had one before, right? So,
Question.
These options, they have been frequently offered to Central Florida.
Have these been offered to Central Florida? Um, A and B have been partners of Certified for a couple years. They're based here in the states. So those two options have been here in Florida. C, D has been too. They're right up in Lake Mary. So that program's been available, and I just got us re-signed up to offer that program. But C is new. They haven't been in Central Florida before.
Because I heard that you said that some options have been offered more frequently in Miami area south.
Yes, right,
And what we can notice that mainly from Brazil, the target for the investor is Miami,
right,
probably because they already have tons of options to buy and to invest in properties without doing a lot of documentation.
right. The question is, could Miami have had an advantage on Central Florida over the years, but by some of these options that they have? I You know your borrower a lot better than I do. I think there's a different type of borrower that will go to Miami that will go to here. I think if you're a family-oriented borrower, you're probably going to gravitate more towards Central Florida than South Florida. If you're a single guy, Miami's where it's at. I mean, it's or business, right? Yeah, Miami is the Latin capital of the world for business, so it's financial heavy there.
When you talk about what's the best rate of return of investment, when you talk to Central Florida, mainly Orlando, you have the pool, the tourism pool,
Right,
that is different than Miami.
right,
So that is something that I think Brazilian investors they go through Miami probably because they don't need to have this amount of information to give to the banks. So that's what I'm concerning. If we have these available opportunities,
hmm
we can be more aggressive with the investors,
right.
saying, okay, if you invested here in Central Florida, it is a green market, it's not a mature market, so you can spend less money, you can get more for your dollar investment, but we still have the options of Miami. That is the first time I'm seeing
Right.
this kind of lending.
There's a when the crunch really hit and the questions reverting back to Miami and Orlando, there was a point in time in Miami, I believe in '08, there were 45,000 vacant condos, and there were another 20 that were drawn up to be built. I mean, it just became this condo haven, and everybody took a bath on it that got in on the ground floor. No pun intended. But it's I think from a return on investment standpoint, I would be personally more bullish in Central Florida. I see Central Florida becoming less tourism driven and a lot more medical driven. If you look at the medical park over at Lake Nona, if you haven't been through that, Orlando finally became a dot on the map for the medical industry. UCF's second largest school in the United States now. Um, it's diversifying itself. You got a super airport. I think that dwarfs Miami. Um, Golf courses, much more family oriented. I still go back to it's a different type of borrower that you want. But I don't know if you could track. It'd be interesting to track borrowers in the states. I don't know how you do it because typically on like C and D here, they're collecting the visa just to verify for themselves. They're not reporting that. Where a bank would have to report demographics of the borrower. Uh, those options wouldn't do that, so it'd be hard to track. But you'd know better than the little bit I would know about Miami. I just see it as two different marketplaces. We've had a good run of foreign national buyers here. The 27 corridor is very strong with foreign national corridor, and that did take a little bit of a hit in the downturn of the marketplace. But with the timeshares and most of these resort areas being near the attractions, that's still the long term. The long term play, I think, is what's drawing. And I think, in speaking to some of the investors, one of the twists that I think I'm seeing is a lot of families like coming to Central Florida, but they've been to Disney, they've been to Universal, been there, done that, but then they can come to some of these communities that you're in that have their own water parks, that have their own restaurants, have their own golf courses. They never have to leave the resort, but they like being in Central Florida. It's a comfort zone for them to come over once or twice a year, rent the property out the rest of the time, and if they want, go to Disney, go to Universal for a day, not spend their whole. Right, it's a trip away. You're right.
Also,
Chris?
keep in mind that not only restricted to Central Florida, but we sell anywhere in Florida. So if we have a good, true investor that wants in Miami, that's going to find out and that's going to do it.
If you've got if you come across a buyer that is interested in Miami, there's probably more options than this. I only took those that would entertain coming up to Central Florida. And like I said, I think you're going to see a shift in the next couple months. By the end of summer, you'll see a better product line coming in here with better guidelines on it. Wh- Yeah, we're licensed in the state of Florida. Yep, yep. Yeah, we're licensed in the state of Florida.
In terms of mortgage market, what do we project to see in the next 4 to 5 years?
Where the market's going in the next 2, 4, 5 years. Yeah. Like I said, with all due respect, if I knew that, I'd be on a boat somewhere right now. I'd have all the answers. It's if you pick up the one thing I wanted to share with you, and I'll send it to Desiree. There's a daily free newsletter that comes out. And it's really good because it talks about, it's light humored, it's written for everyone to understand, and it addresses some issues long term. And it's always kind of making fun of, someone says something in Washington one day and the bond market just goes nuts, right? And then Russia decides to invade, and then everybody throws their money at the US dollar because the whole world's going to go to war. And it just fluctuates up and down, but yet rates, one day I get a note, rates were up a quarter opening the day. By the end of the day, they're down 3/8. I don't think you sell on rate. I think you sell on long-term investment. And I think I'd rather be here in the next 2 to 4 years than Peoria. I think there's a lot more opportunity here. This doesn't go to Peoria, right? All right. That's in Illinois. If anybody knows, it's a dead part of it's always kind of a joke in the United States, it's Peoria. But yeah, so I think a lot of people are very, very bullish on what's going on, and it's fascinating. I was at a meeting the other night that turned into something that I was totally unexpected for. There was an advisor there from Goldman Sachs in New York, and he spoke. Is anybody familiar with the shale lining in the United States? What the shale is? We discovered shale has grown underneath the United States in certain parts. It's a rock made of oil, and they blast water into this, and it rises to the top. They suck it up, and there's oil. In North Dakota alone, there's more shale than oil in the entire world. We are, and it was funny because it hit home. There was an investor there on the other side of the table, and he invests in homes, and he hires contractors to fix them up. Well, he had a contractor he paid $7.99 an hour to do flooring for. So he called up and he says, I have a home I need you to do. And he goes, Frank, I'm in North Dakota making $25 an hour. Paying 3 times of what he's making here in Florida. The average income for a student graduating from North Dakota University is $89,000. It's the highest in the country. They're graduating and going to work on the shale projects. So that change. But why I bring that up is all of a sudden now the Mississippi Delta region is thinking, well, that shale's got to get to the Gulf somehow, right? So they're starting to widen the Gulf. They're starting to widen the ports there along the Mississippi. So you have transcending things like that, where we could actually, as a country, revert to a manufacturing power where we haven't been since World War II. That happens, you stabilize the economy. Long-term rates stay down. You can manage inflation. Conversation I wasn't even prepared for. And it was just when you listen to it, it was very interesting because the long-term impacts are huge. I know I went over my time. Do I have 5 minutes? I wanted to address some domestic options so you know what we have here. Jumbo loans over 417 can be very pricey with mortgage insurance. We have a product you can go up to $85 million loan amount. Credit score is 740, no MI. Slightly higher rate than usual, but the no MI factor is very important because mortgage insurance on a jumbo loan can be a couple $100. Remember, 95% financing, 5% down money can be a gift. So for domestic buyers, the minimum down payment now is 5%. That can be gift money. In the past, it used to be hard down money that the borrower had. Now it can be gift money. Are you familiar with the HARP loan in the United States? HARP loans, this may come into play for you. HARP loans is part of the Housing Recovery Act, where if you were upside down on your house up to 175%, you could recast your loan using a HARP loan. They didn't get a new appraisal. They just flipped it to fix your payment. And the reason they did that, they wanted you to stay in the house. So if someone owed $200,000 on their house went to $100,000, we could refinance their loan at today's rate. The LTV was totally out of the ballpark, so they didn't require an appraisal on it. It's very limited documentation, but it reduced the payments of the loan in order for the less risk the person will stay in the house longer. A lot of people don't know you can have an investment property that can be a HARP. So if you have an individual that owns a unit here that you run across and they say, I bought this investment for $150,000. It's worth $75,000 now. I owe $100,000. I don't know what I'm going to do. Call me. So we can do a HARP loan for investment properties, and that's big in Florida. Yeah, I just found that out about 2-3 months ago that you can do that. One of this you might come across as well. Delayed financing. You might have an individual come and buy a house for cash. And typically what we require in the United States is to reside in that house for 6 months before we can refinance them out. In a delayed financing option, if the individual wired money from an investment account to purchase the product, we can get a copy of that wire and refinance that individual 30 days later. So a lot of people have in their mind, I just bought this house. I can't get my cash out for 6 months because as those are Fannie Freddie guidelines. There is a way out of that called the delayed financing, and as long as we can source where that money came from, you can refinance them out. And it happens because people stumble across properties and they'll walk in and the buyer goes, give me $120,000, it's yours, and they write them a check. But they want that money back, so we just have to source the funds and I can refinance their funds. Question. Question. We have an outlet for reverse mortgages. I do not do them myself, but we do have an outlet for reverse mortgages. Question was reverse mortgages. We do have an outlet for it with one of our investors. That's all they do. Typically, if you run across someone that does reverse mortgages, the rule of thumb that I feel is that's a very, very specialized, unique product, and that's probably all they should be doing. And in our case, the investor we have, that's all they do. You can't, that's not one of those jack of all trades where you put a reverse mortgage in your tool bucket and go out and say, oh, I have this. That's a whole different animal that you got to be very careful on. So I would recommend if you come across that, I do have an investor that handles specifically that. But if you do run into another option or they're talking to somebody, just make sure that specifically that's what they do is reverse mortgages. You had one other question? We got it. Okay. The last one yes. The question is, have the options opened up? Recently, years ago, you had two products. You had a 30-year fixed, 20% down. Even back in the 80s and the 70s, and it was standardized. Then when inflation and the interest rates hit in the late 80s, adjustable rate mortgages popped on the scene. That changed everything because now you could borrow on a 1-year arm, a 3-year arm, a 5-year arm, interest only. The next thing you know, when I was at Sun, we had 200-300 products. So you went from a very stringent vanilla to investors that would offer, you name it, you could shop it around. The crunch hit, as everything we do in this country, the pendulum swung to the other side. All of a sudden, those product layers went right back together. So in the last 2 to 3 years, these have become much better. So every day I see a little bit more coming into play. So it is strengthening itself up, but it will never be where it was, and that's probably a good thing because we all did some foolish things, myself included. But it is coming back. But the important thing is the idea of home ownership, affordable home ownership, and the ability to make sure the individual can pay for that is paramount right now, and that's what you hear as the underlying guideline. So it is coming back. I should have done this for you before I got here, but USDA loans, this is a residential arm of the United States Department of Agriculture, and they do rural financing for homes that are in rural areas of the United States. It's 100% financing depending on your borrower. And that can go by county. The down assistance of 10,000. Have you done one?
I did one. Do you do RSPs?
Mm-hmm. Where did you do it at?
I did it with Orange County. It was a beautiful experience. I learned so much.
So Orange County, how long ago?
Just about 45 days.
Okay, good. What you do is you go to the USDA website, and I should have this as a slide, but I just didn't think of that. And they'll have maps of every county. So typically, the more rural the area, Osceola and Lake has a lot of them. Check Polk, check that address out, run it by the engine on USDA. If it's a hit, call us. There's some qualifications for the borrower income-wise, and they vary. But in the rural areas, that's a wonderful product to have that a lot of people forget about. And the VA loan for anyone that's served in that services is still 100%. Stacy and my website right now, mine defaults to hers, and I'll show you real quickly. You're going to be proud of me, Dig. I know I'm going to do this right. Maybe not. Oh, there we go. Very good. There you go. This will come up under mine and Stacy's. Some clients at their leisure can fill out an application on their own, and under her particular site, she has a blog. She has mortgage information. Mine isn't up yet. You'll fill out this information, and there's an app. Finger up. There you go. I'm getting it. I'm getting it. I'm getting it.
Apple for you.
There you go. Yeah, you can tell I'm not an Apple guy, right? All right. Apple and bankers do not intermix. You have a payment calculator here that you can easily access. And you also, if you know, you can get payment calculators on your smartphones, free apps as well. And they're also they can do their own loan application here at their own leisure. So when they're flying back to Brazil, if they have the internet, they can do the application on here, and it automatically uploads privately. She and I share our search engine, so it automatically pops up and populates our field. We can do the analysis right then. By the time they land the plane, I can have them pre-approved. So that's real easy. My cards are here. So even if you go under my website, it defaults to hers, and because her profile is better looking than mine, so I might just stick with Stacy's instead of scaring people away. Any other questions? Yes.
The options of mortgage for foreigners, can it change if the client is a senior or if it's younger? How about the age?
Age?
Yes.
No. Um, you're running into even portfolio discrimination issues. So the question was, does age run into a age or um, professional type? No, it really doesn't.
The rate no change.
No, there's no tiered rates where if you're if you're 21 you get this, if you're 62 you get this. You won't run into that. You don't.
You already have investment properties you want to get some cash out. Do you have any
The question is to refinance cash out investment properties. The answer is yes. Call me and run it by me. Um, Option B does it. Option A, I do not believe does do it. Um, if they do it, it's going to be capped. You're not going to get, yeah, you're not going to get a whole lot out. It might require a little bit more documentation, but if you there are options out there. So if you do have an investment property that they want to refi cash out, call me and I can review the options. Or call Desiree and we can review the options. I did not attach any slides with refis today. Cash outs, yes. Typically, you can't require once that cash goes to the buyer. Where the question is, where does the money go when you get the cash out? You really can't require it because there's really no way to track it. So if the money goes all back to Brazil for whatever reason, uh, they really can't control that. The only thing that they can control is prior to close where the money's coming from, how long it has to be in that account, and or if it's a purchase, what the reserve requirements are going to be for that loan, 12 months or 24 months. But if you're cashing out on it, to my knowledge, they're not going to say you have to keep that in the United States. It defeats the purpose. But it is a little bit more challenging on a foreign national to do a cash out refi. Anything else? I know I threw a lot of data at you. You can call me anytime. You can call my cell phone at any time. That's on the card. I'm sorry? Well, thank you. Thank you. I appreciate your time. Thank
See, you got this, man.
I almost had it. There you go.
Huh?